When most people think about banking, they picture something familiar. Savings accounts, credit cards, branches on city streets. They assume banks are heavily regulated, monitored, stress-tested, supervised. But alongside that visible system exists another financial network. It moves trillions of dollars. It finances corporations. It shapes asset prices. And it operates largely outside the regulatory guardrails designed after the last financial crisis. It's called the shadow banking system. Welcome to Rook. Today, we examine what shadow banking really is, how it grew so large, and why some economists believe it represents one of the most complex and least understood risks in modern finance. Because financial crises rarely begin where everyone is looking. They begin where leverage quietly accumulates. Despite the name, shadow banking is not illegal. It refers to non-bank financial institutions that perform functions similar to traditional banks, but without the same regulatory structure. These include hedge funds, private equity firms, money market funds, structured investment vehicles, finance companies, certain private credit lenders. Unlike commercial banks, these institutions generally do not take insured deposits. But they do extend credit. They provide liquidity, they facilitate borrowing and investing, and they play a major role in capital markets. According to the Financial Stability Board, non-bank financial institutions account for a significant portion of global financial assets, amounting to tens of trillions of dollars worldwide. This is not a marginal sector. It is a parallel financial system. To understand its rise, we need to go back to the 2008 global financial crisis. After the collapse of major institutions, regulators strengthened rules for traditional banks. Capital requirements increased, risk exposure was limited, liquidity buffers were enforced, banks became more resilient, but tighter regulation also meant reduced risk-taking capacity. At the same time, investors were searching for higher returns in a low interest rate environment. The demand for credit did not disappear. It shifted. Private funds stepped in to provide loans that banks were less willing, or less able, to make. Corporations increasingly turned to private credit markets. Investors poured capital into alternative assets. The financial system did not shrink. It diversified, and much of that diversification occurred outside traditional banking oversight. But diversification can mean dispersion of risk. And when risk spreads across institutions that are less transparent, it becomes harder to see where vulnerabilities are building. Shadow banking often relies on leverage, borrowing to amplify investment returns. It frequently depends on short-term funding to finance long-term assets. These structures can be efficient in stable markets. But in times of stress, they can unravel quickly. If investors suddenly demand redemptions, if asset prices fall sharply, if lenders pull back short-term funding, liquidity can evaporate. Unlike traditional banks, many shadow institutions do not have access to insured deposits or routine central bank support. That makes them more sensitive to market confidence. And financial markets can turn rapidly. The concern is not everyday operations. It is what happens during panic. Shadow banks are not isolated from traditional banks. They borrow from them. They transact with them. They hold similar assets. In some cases, banks provide credit lines to non-bank institutions. This interconnection means stress in one sector can spill into the other. The 2008 crisis revealed how off-balance sheet entities and structured vehicles amplified instability. Since then, oversight has improved. But innovation in financial markets is constant. Risk does not disappear. It migrates. And often, it migrates toward less regulated areas. Shadow banking is not limited to one country. In the United States, private credit markets have expanded significantly. In China, trust companies and wealth management products have historically played a central role in credit expansion. In Europe, investment funds and non-bank lenders are increasingly important in corporate financing. Because capital flows freely across borders, regulatory gaps can create opportunities. When restrictions tighten in one jurisdiction, activity can shift elsewhere. This global mobility makes oversight complex. Financial markets are integrated. Regulatory systems are national. That mismatch creates blind spots. Periods of market stress often reveal vulnerabilities in non-bank finance. During sharp market downturns, leveraged funds may face margin calls, requiring them to sell assets quickly. Forced selling can amplify price declines. Liquidity can dry up in markets that appeared stable. In recent years, central banks have occasionally intervened in bond markets and funding markets, indirectly stabilizing institutions beyond traditional banks. This raises an important structural question. If non-bank institutions rely on public intervention during crisis, are they truly outside the system? Or are they part of it, just operating under different rules? It is important to recognize that shadow banking is not inherently harmful. Private credit can support small and mid-sized businesses. Investment funds can provide diversification. Financial innovation can improve efficiency. The issue is scale and transparency. When a parallel financial system grows large enough, its stability becomes a public concern. Even if it operates privately, the challenge for regulators is delicate. Overregulation may stifle innovation and credit availability. Underregulation may allow systemic risks to build unnoticed. Finding balance is difficult, especially in fast-moving financial markets. Perhaps the greatest concern is not leverage alone. It is opacity. Shadow banking structures can be complex. Data may be limited. Interconnections may not be fully visible until stress exposes them. Financial crises often surprise not because risks did not exist, but because they were underestimated. And in a system measured in trillions of dollars, small miscalculations can scale quickly. The question is not whether shadow banking will collapse. It is whether its risks are fully understood. The shadow banking system is a product of modern finance. It emerged from regulation, innovation, and global capital flows. It supports economic growth, but it also concentrates risk in less visible channels. In the 21st century, financial stability depends not only on the institutions we see, but on the structures operating quietly alongside them. Because when financial shocks arrive, they rarely begin in the spotlight. They begin in the margins. And understanding the architecture of risk is essential in a world built on interconnected markets. If you found this analysis valuable, consider subscribing. Because the forces shaping global finance are often hidden, until they matter most.